Welcome to chapter 16, homework help. So I've got 16 questions in this assignment, and I'm willing to bet we're going to be working on a cash flow statement problem. So we've got a few extra multiple choice in here. We are classifying the following cash flows as either operating, investing, or financing. Cash payment from customers, that's always going to be operating activities. Cash paid for cash received cash from sale of land. It should be investing activities. And then looking for one that should be paid long-term debt with cash. That should be financing activities. Okay, those are just some examples. Let's check our work. I probably screwed one of them up. No, I did them right. Sometimes I get them mixed up in my head. So I'm going to let you do the rest of those. I didn't want to do the whole thing for you, but just get familiar with the things you need to do so you know where to put everything, okay? Cash flow from operating activities using the indirect method, all right? So right here, we're going to click net income. It was 17. This is basically doing the operating activities section of the cash flow statement. Changes in current assets and liabilities. Comparative balance sheet shows the following accounts. Accounts receivable increased. So we're going to decrease it by 8,600. Inventory decreased. We're going to increase. Prepaid insurance decreased. We're going to increase that. Accounts payable increased. So we're going to increase that because that's a liability. Sorry, I'm kind of just going through it and I should stop and explain it. These are all current assets right here: prepaid insurance, inventory, and accounts receivable. If they increase, we're going to decrease our net income. If they decrease, we're going to increase our net income. Conversely, with current liabilities, which is increasing accounts payable. Accounts payable is a current liability. With an increase, we're going to increase net income. And with a decrease, we're going to decrease net income. So we're going to decrease taxes payable decreased. So we're going to we're going to decrease, sorry, 4,600. And that looks like it. Okay, again, all because there's this extra line doesn't mean we need to use it. So this is net cash provided by operating activities. Let's give our check answer here. Good. All right. Hopefully you guys, if you have any questions on this, hopefully it'll be answered here shortly. And what I mean by that is that, we'll be doing another cash flow stuff here in a little bit. That was kind of just your primer to get you ready. Oh man, I am needing the water today. We got our comparative balance sheet, we got our income statement, we got our additional information. My guess is that we are going to be doing a statement of cash flows. Here we go. All right. So this one, statement of cash flows using the indirect method. Let's find out. What was our, okay, we had a net income of 103,510. So we're going to go net income, 103,510. Yes, just double checking. All right, adjustments to reconcile net income to net cash provided by operating activities. Income statement items not affecting cash. First of all, we're going to have looking for depreciation. First of all, I guess we got to find, well, just depreciation expense, yeah. So we have depreciation expense, 60,600. Let's go back up here and see, because I already saw a gain somewhere. Gain on sale of equipment, $2,200. So let's come down here and we're going to put gain on sale of equipment. And what was it again? 2,200. So we got the gain. I got to subtract that. I got to go put that as a negative. Okay, looks like we're good. Okay, remember, gains are subtracted, losses are added. So that's the income statement, things not affecting cash. So we did that. Now we got changes in current operating assets and liabilities. Let's come up here and check this out. Let's start at the top. Cash, that's what this statement's doing. Accounts receivable, and it looks like we increased by $15,000. Let's come down here. Going to be increase in accounts receivable. So we're going to decrease $15,000. Remember, current assets are going, if they increase, we're going to decrease it from net income. If they decrease, we're going to increase net income. So that's what we're doing. Inventory decreased, so we'll increase this by 89,500 minus 23,700. And that was a decrease to inventory right there. Oops. All right. So inventory is done. Prepaid expenses decreased 5,800, 4,600. So it decreased $1,200. And it decreased, so we're going to increase it. Oh, there it was. Decrease in prepaid expenses. Okay, I think that covers our assets. That's a game. Cover your assets. Our current assets. Let's go look at our current liabilities. Let's say we have accounts payable, wages payable, and income taxes. Decrease, decrease. They all decrease. So we're going to look for all three of them so it saves us some time. Accounts payable, wages payable, and taxes payable. They all decreased. So decrease in accounts payable, decrease in, was it wages payable, and decrease in income taxes payable, I think it was. Oh yeah, there it is. Income taxes payable. All right, now let's go find out how much we had in each one of those. Accounts payable was a decrease by 6,000. So let's go do that. Since it was a decrease, we're going to decrease it because it's the opposite with the liabilities. Wages payable, 9,200. And then income taxes payable, 4,236, $600. Okay, and we're done. All right, we don't have to do that last line. This is going to be net cash provided by operating activities. We're positive. That's a good thing. Okay, so we'll go ahead and move on now to our investing activities. Just coming over here, looks like we have a notes payable long term, and we have equipment we want to look at. So cash flows from investing activities. Let's look at our additional information. A 30,000 notes payable is retired at its $30,000 carrying book value in exchange for cash. All right, so we paid $30,000 to pay off our notes payable. We're looking for a cash paid to retire notes. There it is, okay? 30,000. And let's just make sure and verify that. Yeah, it went down 30,000 there. Now let's look at our equipment. Our equipment goes up by $9,000. Let's look and see what our equipment. New equipment is acquired for $59,600 cash. So what we're going to need to do is I'm going to open up an Excel file. And we got to analyze the equipment account. And in so doing, the accumulated depreciation as well. Okay. Um, there we go. All right. So in our equipment, come up here and I'll reopen it here. In our equipment account, we started off with $117,000. Our accumulated depreciation had 10,000. We know that we sold equipment, or wait, hold on a sec. New equipment is acquired for 59,600, and then we sold equipment for 50,600. So let's see if this accounts for our $9,000 increase. All right, something else happened probably. Let's see if we can figure it out. Or let's see if our ending balance actually equals that. Oh, it does. So we are good. I thought it was. Yeah, so our increase was $9,000. Okay, we're good there. And let's look at our accumulated depreciation. This is how you would figure out if you didn't have the information about gains and losses, if you had a gain or loss on the sale of this equipment. So our accumulated depreciation went to 28,000, and we had depreciation expense of 66. Six. 66. Okay, there it is. So what accumulated depreciation did we have to get rid of to get to $28,000? So we're going to take ending balance. Hold on. Let's do a subtotal here just to make it easier. Okay, so we need to come over here. We need to take this minus this. So we had to get rid of $42,600 in accumulated depreciation on that sale of equipment. So we're going to look at this journal entry. Accumulated depreciation was our debit for $42,600. We had equipment, excuse me, equipment. I'm in my home, so when I sneeze, it's fine. 5,600. And then let's find out what we did as far as cash goes. New equipment is acquired for $59,600 cash. So we got, oh, that's new equipment. Sorry, we received $50,600 cash. Oh, we received cash for this yielding a $2,200 gain. Okay, so we received cash, and then we said that we had a gain of 2,200. So what we're going to do is we're going to take, oops, minus that. So we had cash we received as $10,200 from the sale of that equipment. That's what we're looking for when we're doing this. I know that's really involved, but that is what we're looking for on that piece of equipment. So we're going to come down here, and we're going to say cash received from sale of equipment was it 10,200? You might need to rewatch that a couple times so that you kind of understand what I just did there. And then we had new equipment for 59,600. All right, so again, what I did was I evaluated the equipment and the accumulated depreciation accounts in order to find out how much cash we got for that sale of the equipment. We knew we got the $2,200 gain. It was listed there on the income statement and in the additional information. But even if we didn't have that additional information, it told us in that little snippet that we had a $2,200 gain. So because of the gain, it's going to be a credit. It's going to increase our net income. And then we're going to get rid of our equipment, which normal balance on an asset is a debit, so we're going to credit that. We're going to get rid of the accumulated depreciation. Normal balance on the accumulated depreciation is a credit, so we're going to debit that. And we just have to find out what the remaining amount is to get the cash. So when evaluating this, again, I did a subtotal right here, not to be confused. So I added these two together, which was the beginning balance plus the depreciation expense. That got us the subtotal, and then I knew what our ending balance was. So I knew the remaining amount of accumulated depreciation that was decreasing this was related to this sale. Otherwise, there would have to be some other additional information for them to tell us that. I evaluated the equipment account by taking the beginning balance and adding to it the amount of the equipment that we bought. And then I knew our ending balance, and that could tell me how much our equipment was that we got rid of, the cost of that. So I was able to plug that in based on this analysis. I was able to plug this accumulated depreciation amount in based on this analysis. Gain was given, and so I could compute and calculate the cash amount. So that's how I did that. So now looking at our investing activities, this is a really good situation. You're saying, Brian, but you have a cash outflow. But that's okay. We retired the debt, and we bought more equipment and sold old equipment. That's a good thing. So even though we have a cash outflow here for financing activities or for investing activities, that's fine. Not only do we have a positive net cash flow from our operating activities, but our negative outflow shows that we're spending money to improve the company, to get better equipment, and to keep working. So this is a good thing. So I dare say regardless of what we find in the financing activities, I feel comfortable and feel good about and wanting to invest in this company. Now, a matter of dividends and all this other stuff, we'll debate and figure that out and go from there. So we've already did letter A, letter B, effective retained earnings and net income and cash dividends. Great. So that's good information. So we haven't done B. C and D are done. All prepaid expense wages relate to operating activities on the income statement. Great. We're done with that one. All purchase and sales of inventory are on credit. That's necessary because otherwise we would need to evaluate it differently. But anyway, all that stuff is done. We're good. So the last thing on here is we just need to do the retained earnings. Just the retained earnings. Let's come up here now and we're going to look at our equity situation. We have our common stock. So it looks like we issued some common stock. Par value is $5 per share. No additional paid in capital, so we had to have sold it for cost or with the par value. So we got $62,000 cash from that transaction. Now, if you're wondering how many shares we got or we sold 12,400. I just divided that by our par value to get the number of shares. All right, but we received $62,000 cash from issuing common stock. Cash received from the issuance of common stock. I already forgot the number. 62,000. All right, and now we got to evaluate our retained earnings account. All right, let's pull open that spreadsheet again we were working with, and let's evaluate this. I'm just going to copy and paste this so I don't have to reinvent the wheel. Retained earnings. Okay, our retained earnings balance was 24,700. Now it said only dividends and net income impacted our retained earnings account. So let's go and look at what our net income was to remind us. So we had an increase on retained earnings by our net income amount. Should have put the ending balance on there too to save me some time. I'm gonna click between everything. 342,700. Whoa, that was the total equity, sorry. That's what it should have been, 49,900. All right, so we increased a lot here. So my guess is we're going to take this. No, we're going to take the sum of these two and subtract out our ending balance. So we paid out dividends of $78,310. Because we already accounted for net income, we just have to account for our dividends. 78,310. All right. Cash balance at prior year end, 46,000. 106,300, 106,300. Woo! So unless we flood something in here, this should be perfect. The numbers should be good. Maybe we miscategorized something is what we would look for. Answer is not complete. Cash paid to retire notes. I wonder what I did wrong on that. I was pretty comfortable with that one. Let's go have a look. Oh, you know what? That's a financing activity. That's why. Cash paid to retire notes. See, sometimes I still screw up. So let's just zero that out. Now let's fix it. I don't know why I put the notes thing in there. I just totally bombed that. Yeah, notes are supposed to be under the financing activities. All long-term liabilities are supposed to go under financing activities. And that makes sense. It's not investing in anything. Now, if I had bought somebody else's notes or sold those notes that I bought from somebody else's company, that's what I was putting in investing activities. So that's why my brain was doing that. So I apologize for flubbing that. Okay, looks like number 16 and the last one is another cash flow statement, but this one is going to be, oh no, this is just the second part of this. We are going to be doing cash flow on total asset ratio. So we're going to be going ahead and coming up with that ratio on this. Now remember, we're going to be taking our numerator is going to be our cash flow from operating activities, and we're going to be dividing it by our average total assets. Excuse me. So that's what we're looking for. So what we need to do is we need to go back to our answer here. I think that's why it's not complete unless I missed a header. Oh, I did. I missed a header right here. And I missed the header here. These are probably, no, I guess it was done. I did that there. Okay, that's fine. So then, operating activities was 156,010, 156,10. And then we're going to take our average total assets. So we're just going to come up here and we're going to get our calculator out. And we're going to take 342,700 and add 301,300. That's taking the beginning and ending balance of our total assets. We're going to sum it up and then divide it by 2. So our average total assets is going to be $322,000. Whoa. That's better. 48.5%. So we're pretty efficient. It's not bad. Okay. 48.5%. Okay, that's your homework. You guys, if you have any questions, of course, come talk to me. Good luck, and we'll see you guys in future videos.